Hello friends, so welcome to bispsolutions.com. My name is Ali. So this is again going to be a video for financial consolidation, HFM or Hyphen Financial Management Aspirant. So today we are going to talk about accounting standard starting from IAS and IFRS International Financial Reporting Standards. Accounting standards are needed so that financial statements can fairly and consistently describe financial performance. Without a standard, user of financial statement would need to learn the accounting rules for each company, and comparison between companies would be difficult. Keeping on the same, the International Accounting Standard Committee was formed in 1973 and they initiate 41 IAS International Accounting Standard for accounting and consolidation. Later on in 2001, the organization changed their name to become International Accounting Standard Board and issue IFRS, International Financial Reporting Standard. There are 17 IFRS standards. In consolidation, we use 6 directly accounting standards. So starting with the same IAS 27, separate financial statement. A company, if has subsidiaries, need to submit the separate financial statement along with consolidated statements. So accounting standard 27 prescribe the accounting and disclosure requirement for investment in subsidiaries, joint venture and associate, like investment in subsidiaries, associate at cost, joint venture, or describe any subsidiary in 28 or IS 28 in accordance with IFRS 9. So we'll check in 28. IAS 28 standard. So IAS 28 says this prescribe how to apply the equity method. The equity method when accounting for investments, associates and joint venture. So investment in associate and joint ventures is International Accounting Standard 28. So accounting for investment in associate, investment in joint venture and recognition and measurement. This is also a part of consolidation. Then it comes to starting with the IFRS 3 business combination. The core principle of IFRS that acquire disclose the information that enable users to evaluate the nature and financial effect of acquisition, like fair value, identifiable assets, liabilities acquired, recognize and measure goodwill and bargain purchase if it is there. This was the IFRS 7 business combination, IFRS 3 business combination. Then it comes to the IFRS 10. This basically starting with a consolidated financial statement. When an entity control one or more other entities, business need to follow IFRS 10 principle for presenting and preparing consolidated financial statements, like identifying the investee, consideration of its purpose and design, identifying relevant activities of investee, identifying how decision about the relevant activities are made, assessing whether the investor control the investee or not. When it comes to the IFRS 11 joint arrangement, when control is a jointly between two or more parties, we need to follow IFRS 11. IFRS 11 classify joint arrangement in two types, like joint operation where the two entities come together for one operation and they perform operation with their own assets and liabilities, where they form another venture, joint venture. They form a joint venture where the venture has assets and liabilities arranged by control. Then it comes to the IFRS 12 disclosure of interest in other entities. This is also the same. IFRS 12 require disclosure information that enable users to evaluate the financial statements, like interest in subsidiaries, effect of interest, associated risk, arrangement, and unconsolidated structured entity. So this was the IFRS 12, and these are the six standards used in financial consolidation. So one should know all the standard thoroughly. So this was the short intro of IFRS standard and IS standards. So that's all for today. If you have any question or query, please comment below or visit our website to engage an expert at www.bispsolutions.com. Thank you. Have a great day ahead.